Good afternoon, and welcome to the Techcombank First Quarter 2025 Financial Results Presentation. As this event is being broadcast, we would like to remind those of you in the live audience to please put your mobile devices on silent. Today, Jens Lottner, CEO, will begin the opening remarks, and Alex Macaire, CFO, will share more details of the financial results and business updates, followed by a questions and answers session. Jens, separate link. As usual, there will be another call in Vietnamese tomorrow for retail investors. Today's presentation and Q&A will last about 90 minutes. With that, I'll turn it over to Jens to begin the presentation.
Thank you, and good afternoon, everyone. I think these are interesting times, and I'm pretty sure we will probably go a little bit deeper into it. And again, probably it's fair to say that we are right now experiencing some unprecedented volatility in the markets and probably some developments which will play out over the next couple of months and probably potentially years. And we will see how that affects Vietnam, how that affects the bank. But overall, we still think that this is turning out to be a very good story overall for Vietnam. And in that light, and also the first quarter for the bank was actually very good, and it was the second highest quarter ever. And it was a little bit lower than the first quarter last year, but again, we had some kind of one-offs, and even last year where we reminded already at this point in time that this should not be taken as kind of a new norm, but that this would actually come down over time because there were some one-off records which we had in the first quarter of 2024. So you see there's a little bit of a downtick on TOI or PBT, but then if you compare it also against the quarter four of last year, and there was quite an uptick. So again, I think TOI was still very stable, and I was a little bit down. But again, there were some trading income in the first quarter of 2024, which basically has not been repeated in this quarter, and therefore year on year we're a little bit down. And PBT is still very strong, 7.2 trillion, and that should be very much in line with the overall guidance which we have given for the year, and which we will also discuss more in the AGM on Saturday, where we basically guided towards a 31.5 trillion overall profit for the year. And return on assets still stands very strong, 2.3%, a little bit down again because PBT is a little bit down, but still an industry leading. And CASA again also a little bit down, but still very much kind of in the leading position for the market. And NPLs roughly at the same level like what beforehand, roughly 1.2. There's a little bit of volatility in these numbers, but CAR and again still at a very, very strong level of 15.35% and well above regulatory minimum, but also well above our peers. So therefore again, I think it's very much in line with the underlying health of the balance sheet, the overall structure of the book. And again, we are expecting that this will continue over the year. So we're off to a pretty good start from our perspective. Again, as we said, we will look deeper into some of the headwinds, which we will all be facing. But again, we believe, as I said, that we should actually maintain that momentum over the next quarters to come. With that, let me hand it over to Alex, our CFO, to give you more details on the numbers.
Good afternoon, everyone, and sorry that the microphone was not on. So I will start again with an overview of the macroeconomic environment. As I said, there's been a lot of volatility and surprises, and Jens alluded to that. The main question is what will be the impact of the additional US tariffs on Vietnam's economy. So US accounts for roughly 30% of Vietnam's exports, and the export sector in total accounts for maybe 20% of Vietnam's GDP. So we are clearly talking of a significant engine of Vietnam's economy. Right now, as Jan said, we are at the very beginning of the 90-day moratorium, and it's very difficult to predict how things will pan out. I will therefore talk about potential scenarios later, and for now, I will just stick to what we know and can observe. So the economy, Vietnam's economy started 2025 with a very robust momentum. GDP grew 6.9%, export grew 10.7%, and domestic demand, which in the past was relatively subdued, grew 9%, which compared to 7% in the same period last year. So new FDIs did slow down a bit, but then we need to keep in mind that this was before the announcement of the new tariffs in the US. And speaking of the situation today, I can observe that there are a number of FDI projects which are just going ahead because they are about building capacities to cater to Asian markets and are not impacted, therefore, by what's happening in the US. On the flip side, the government has put in place a very comprehensive pro-growth agenda, which includes projected investment in infrastructure for up to 5,500 trillion dong in the next 5 years, includes also experiments on financial deregulation, and it aims at putting Vietnam at the forefront of technological innovation in areas like blockchain or AI. So as a result, the stock market was relatively quick to recover after the announcement of the reprieve on US tariffs. And as of yesterday, it was down a moderate 6% compared to the day immediately before the announcement of the tariffs, which I think is a relatively robust performance relatively to other markets. So overall, I don't mean to say that the potential new tariffs imposed by the US administration will not impact the economy, because it will clearly hurt. I just want to highlight that there are some factors, so like the investment made by the government, the perspective for Vietnam to also, as Jens mentioned, enter a new phase of significantly higher potential growth. All these factors suggest that we should just take a more balanced stance, probably. Looking now quickly at the banking sector, so we can see that the growth of credit this quarter was quite significant. It reached 3.9%, which is significantly more than the same period last year. The competition between banks at the same time remained quite intense, and this translated into very low rates on the asset side, which is good, obviously, for credit demand, but also at the same time hurts the margins of the banks. On the funding side, the liquidity in the sector continues to be tight, so the system continues to rely on the equity capital injections and funding injections from the central bank. And in this context, term deposit rates are very tightly monitored by the central banks, and as a matter of fact, up until now, they have remained relatively contained. But you can already see that the current equation of very strong growth on the asset side, constrained liquidity and low margin will soon be relatively challenging for some players. As far as we are concerned, we acknowledge that our NIM came under pressure on a quarterly basis. It was at 3.7% in the first quarter. And we expect that it could hover around this level for some time, which means that for the full year, it could be a bit below the 4% that we had guided before. Let's look now at financial highlights. As Jens said, it was a robust quarter, which puts us on course to achieve our PBT target of 31.5 trillion for the full year. NII and NFI were a bit down. However, at the same time, we are comparing here to a very strong first quarter in 2024, because if you remember at that time, the banking system was progressively transitioning to a low rates environment and was doing that while still carrying a stock of relatively high rate assets. And as a matter of fact, a number of banks, including Techcombank, were able to generate significant trading gains just by disposing of part of their book of corporate and financial bonds. In our particular case, the year-on-year variance is also affected by the fact that we had to make some adjustments to our flexible pricing policy in the second half of 2024, and this is therefore impacting the margin in the first quarter of 2025. However, as Jens mentioned, it was the second strongest first quarter in the history of the bank. It was maybe slightly softer on the net interest income side, but it was also at the same time stronger than we expected on the fee income side, and overall it's completely aligned to our intended trajectory for the full year. The bank is operating at a very high level of operational efficiency. As you can see, the cost-income ratio of 28.3% and the return on assets of 2.3%. Our balance sheet also at the same time remains very strong. Our CASA ratio stays around 40% mark. Our NPL capital adequacy ratio are also among the strongest in the industry. We are therefore well positioned to navigate the coming quarters, which I would admit would definitely entail a significant level of uncertainties, but also tremendous opportunities. This is an overview of our P&L. I already commented on the drivers behind the decrease in our PBT year on year. As much as we would like to be able to report a steady growth in our PBT with each quarter being on top of the previous one, financial markets unfortunately do not work that way, and there is always a degree of volatility which is unavoidable. Therefore, for us, what is more important is the medium-term trend, and from that perspective, as you can see on this chart, I think Techcombank is still on a very good trajectory with an impressive CAGR in terms of PBT growth through the cycle, and we believe that we will maintain also a very strong performance this year. This is a new slide which aims at providing an overview of the size and the dynamics of our wealth business. So what do we mean by wealth? In our definition, we are including the insurance business, investment distribution, securities, asset management services, and affluent banking, which means essentially all the revenue that we derive from our affluent customers in general. As you can see, all the segments in our wealth bank grew double digit compared to the same period last year. Assets under management increased by 15%, and the number of affluent customers increased by 78%. So the message essentially is clear. We have a wealth bank which represents around 15 trillion of annualized revenue, which is growing at a very fast pace and which is also highly profitable. It is one of the key factors which underpin our forecast of continuing PBT expansion in 2025 despite the challenging economic environment. Let's now look at our results in a bit more details, and starting with NII. At a consolidated level, we grew our interest earning assets by 17% year on year. Our customer loans grew by 5%, which you might say is a little bit less than what we achieved in last year and the year before. It's I would say it's just broadly in line with our run rate, and our objective to grow our asset books by 20% for the full year. So we have an objective for 20% for the full year, and we grew by 5% in the first quarter. So we didn't grow more slowly or faster, and the reason for this is that our assessment was that margins at the moment in the market do not support or justify that we accelerate the expansion of our credit books. We prefer to maintain a steady progression through the year instead of piling too many assets with a relatively low margin. Our customer funding grew at an impressive pace of 23% year on year, while balances from credit institutions reduced by 22%. So therefore, more and more of our funding is coming from customers, which reflects the strength of our customer franchise. On rates, asset yields, as I mentioned earlier, continue to show some pressure in the context of intense competition, which I described. Meanwhile, our cost of funds remained under control and broadly stable quarter on quarter, and therefore our quarterly NIM narrowed a bit to 3.7% on a quarterly basis and around 4% on a last 12 months basis. Overall, as I already explained, we look at the profitability of our books from the point of view of return on capital, and seen through this lens, then the decrease in our in our net interest margin is partly offset by the fact that we have a higher proportion of fees in our income, and also offset by the fact that we are deploying more and more of our capital toward retail loans, which usually carry lower risk weights. Overall, the bank return on capital is broadly in line, therefore, with our expectations. Looking now at lending balances in more details, overall credit expansion was plus 4% and quite balanced between corporate and retail exposures, both growing 4%. Within corporate exposures, we resumed our expansion in real estate books, and this primarily reflects our assessment of the capital deployment opportunities when seen through the lens of risk-adjusted returns. It does not mean that we are walking away of our objective of diversifying our credit books. This remain our objectives, but at the same time, as we already explained in previous analyst presentations, there could be some temporary volatility quarter on quarter, depending on the full range of financial and risk indicators that we want to manage. The chart on the right-hand side shows some impressive progression in certain compartments of our retail lending books. First, on margin lending, thanks to the rapid expansion of our market share in equity trading, but then also within the others category, we saw some very strong progression from personal installment loans as well as credit to merchant and SME customers, which all carry a relatively high margin. Looking now at the real estate value chain in more details, primary mortgage disbursement showed some robust momentum this quarter. Demand for new apartments remained very high, particularly in the north, but it also recovered in the south. However, momentum was a bit more muted comparatively for landed properties and for secondary mortgages. A few of our customers, particularly business owners, are now showing some initial signs of being a bit more cautious before investing, and this may be linked as well to the context of economic uncertainty around the impact of US tariffs. And this impact of economic uncertainty is obviously a bit more pronounced for the assets like landed properties or secondary mortgage properties, which do not benefit from the same scarcity effect as new developments. Finally, we can also observe a reduction in the proportion of prepayment, which is good for our lending balances, mortgage books, and also good from a NIM perspective. Now a quick focus on deposits. Total customer deposits remain broadly stable this quarter. We had some outflows in our corporate books, I would say in line with the usual seasonality. And then at the same time, we had some very encouraging inflows in our retail bank, which reflects also the momentum, the encouraging momentum that we are experiencing in a number of areas. Retail CASA, including auto earning, grew 28% year on year and 5% quarter on quarter. We are seeing a lot of traction with our new auto earning 2.0 proposition, which includes additional flexibility and higher yields for customers. At the end of March, we had around 3.1 million customers who had already signed up for auto earning 2.0. And if you look specifically at the amount of balances swept to auto earning, then you see that they actually increased by 23% quarter on quarter, which I think is quite impressive. Let's look now at our net fee income. So our total NFI was down 5% year on year, but up 15% quarter on quarter. And I think it was quite positive, and it was also a bit higher than our own internal expectation. Investment banking activities are now the first contributor to NFI. They achieved a record quarter in excess of 1 trillion dong. We noticed in particular very strong demand for funds, which is quite new and reflect also the expanded scope and the expanded range of strategies that we offer, as well as renewed interest from customers for this instrument, in line with potentially increased confidence in financial markets. On Banca, we had a tough quarter, if you remember, in the fourth quarter of last year, due to the termination of our distribution agreement with Manulife. However, we put on new temporary distribution agreements in place, and they are already showing some positive results. Our fee income derived from Banca activities was up 27% year on year, and we achieved the number 3 position in the market. This progression is quite encouraging, as you know, we are looking to double down on our Banca strategy with the setup of dedicated subsidiary for general and life insurance. FX related fees also showed some impressive momentum, up 50% year on year, thanks in particular to new propositions rolled out to retail customers in relation to things like relocation, travels, overseas studies, and so on. On LC cash and settlement, the market hasn't yet fully recovered to the level it had reached at the beginning of last year. However, the context of increased uncertainty in a global trading system could actually play in favor of the LC product, as a number of customers might want to turn to tried and tested payment methods like letters of credit, particularly for new trading partners. On cards, the fee income was again down this quarter. This was mainly due to a technical change in accounting recognition. And then it's the other factors being the changes we made in 2024 to our card propositions to make them more attractive to customers, as well as the continuing shift from customer demand from debit card to QR. Overall, I think it's fair to say that it was still a very strong quarter with encouraging trends in a number of areas. Turning now to OPEX. So like every year, we made adjustments in the first quarter to our bonus accruals in line with the performance of the bank. We also released some provisions that we had booked previously in relation to staff benefits. And those are the two primary drivers which explain why our expenses for salaries and staff costs was down 10% year on year, allowing our overall cost to remain broadly flat compared to the same period last year. You can see also that our marketing expenses went back to a more normalized level after the big uptick in the fourth quarter of 24. This increased spend in the last quarter of last year allowed us to achieve some breakthrough results in terms of brand advocacy. So we made it to number 1 position in the market on brand equity index, and we were also pleased to go back to number 1 position in the first quarter of 25 on NPS. So I think the combination of number 1 position in brand equity index and number 1 on NPS is an unprecedented achievement for a joint stock private bank. As a result of our tight cost discipline, our cost-income ratio improved further to 28.3% for the first quarter of 2025. Let's look now at asset quality. So as you can see, our cost of risk on last 12 months basis improved further to 0.7% and 0.5% net of recoveries. Our NPL stayed broadly flat around the 1.2% mark. We saw some uptick in our mortgage books. However, they were broadly offset by significant improvement in our corporate bank, with NPL for corporate loans now down to a very low 0.25%. Finally, our coverage ratio remained quite high at 110%, which is one of the highest level in the industry. This slide, as usual, provides some additional details on our credit cost. The chart first on the left-hand side showed that our normalized cost of risk, so excluding early write-offs, was broadly in line with the previous quarters. We did see some increase in bucket 2 and NPL formation, mostly from our retail books and mostly from a relatively limited number of customers, and workout for this situation is in progress. Overall, we see this increase in bucket 2 and NPL as a temporary volatility. For the full year, we believe that our mortgage NPL will still be around 2%, and our NPL for the total bank should be broadly at the same level as last year, and in any case, less than 1.5%. Turning now to capital and liquidity. As you can see, our CAR stayed broadly flat this quarter, 15.3%. On the funding side, we continued to derive a high proportion of funding from mobilization from customers, around 78%. And overall, the bank's risk profile, seen through the lens of capital adequacy ratio, funding, credit risk, continues to be one of the strongest in the industry. This is the usual chart which shows how we compare to the rest of the sector, and you can see that on a number of metrics, our performance continues to be significantly differentiated from our peers. This is also a slide we introduced last quarter to show how we are doing on transaction banking side. The key point, as I mentioned, is first number 1 position, NPS and bond equity index, but also our increased market share on domestic payments. Our share of outbound transaction is now on LaPass is now 17.6%, and for inbound transaction it's actually 16.4%. So those market shares, those improvements in brand advocacy support the performance on the bank on fees and also on CASA and auto earning balance progression. So turning now to forward-looking guidance. So as you can see, the high level of economic and geopolitical uncertainty may mean it's difficult to think of in terms of one central scenario. I'm just trying to go back to the previous slide. Yeah, it's better to think in terms of two potential developments. The optimistic scenario would have Vietnam growing by 6.5% in 2025, which compares to 7% in our previous forecast. This scenario assumes that the additional tariffs imposed on Vietnam stay in a range of 15 to 25%, which means broadly in line with our peers in the region. And it also assumes that the full-on trade war stayed contained to China and US. In the pessimistic scenario, on the other hand, we estimate that the growth of the Vietnam economy could be limited to 4%. This would assume that essentially Vietnam is comparatively hit harder than other economies and suffer additional tariffs of up to 46%, and as a result of that, large parts of the international trading system would be subject to a significant disruption. Our current view, to be honest, is that these two scenarios are equally possible, but we would tend to probably side with the government in hoping that we are today heading a little bit more towards the optimistic scenario than the pessimistic one. But the situation is clearly very fluid. Let's look now at our guidance for full year 25. In terms of credit growth, we will continue to guide an expansion of our books in line with 24, around the 20% mark. On cost of funds, we are seeing some favorable impact from auto earning 2.0, which allow us to till now to offset moderated rate increases in the market, and therefore we believe that the cost of funds should stay broadly flat. CASA ratio has some potential for further improvement, particularly if we can maintain the very strong momentum on auto earning, and this support our expectation that CASA ratio could be above 40% at the end of the year. NIM is the one area where we are seeing significant challenges today. As I mentioned, we will try to preserve the NIM as much as possible to 4% or close to this number. However, there is a moderate risk clearly on the downside coming from the very high intensity of the competition between banks. For NII, clearly the growth will be a combination of the expansion in our credit books and partial pressure on NIM. In any case, we estimate that we will achieve double-digit growth. Same for NFI, where we will aim to derive more income from upselling and cross-selling within TCB as well as through our ecosystem. Cost-income ratio, I think, will comfortably remain in the range of 30 to 35%. As for NPL and credit cost, I already explained that we expected them to also be relatively comparable to 2024. We will now turn to our full year PBT guidance, which will be discussed in more details in our upcoming AGM. Obviously, making predictions at this moment this juncture is particularly difficult given the significant range of scenarios that we need to consider, as I mentioned earlier, and also the wide diversity of potential economic outcomes. On the flip side, as already mentioned, we expect that the Vietnamese government will press ahead with its pro-growth agenda. This will open up a range of opportunities in the services and tech industries in particular, and being a leader in the banking sector and a pioneer in the adoption of digital technologies in the financial system, we believe that Techcombank is well positioned to capture these opportunities and outperform the sector. And then last but not least, I mentioned insurance, but we have other exciting partnerships under discussion in a number of areas. And therefore, those are the factors on which we base our guidance of 31.5 trillion PBT for 2025. It will be our first attempt at breaking the 30 trillion mark, and it is ambitious, but it is the objective that we will go after. This brings my presentation to a close, and I will now hand it over to Mindo for the Q&A. Thank you.
Thanks, Alex. We'll begin our Q&A. The first question is for Jens. Could the bank share its views on the macroeconomic situation in the remaining quarters of 2025, especially in the light of the recent U.S. announced reciprocal tariff? Please share your outlook on GDP growth, interest rates, and exchange rates.
So thank you very much for the question. I thought actually that our CFO did an excellent job in describing exactly how that looks like. And so, but maybe let me repeat or summarize again, right? I think as both of us have said, these are very unprecedented times. So, and you can stay and mostly with the facts, and then there's an overlay of political discussions and negotiations, which I think none of us is privy to, and which ultimately determine the outcome. But again, if you look at the current momentum, it seems pretty much that the first quarter was actually still very strong. However, of course, if such an open economy as Vietnam is hit with a tariff on most of its products, which are going to its main export partner, at 46%, which is significantly higher than the surrounding neighboring countries or countries you're competing with, then again, I think that is indeed a massive shock to the system. So because ultimately, even if it's called reciprocal tariff, it is only linked or mostly linked to the trade surplus. There's only two ways you can go. You can either buy more in US dollars or you can sell less in US dollars to the US. I think buying more is, I think there are all the attempts made on what would you buy, and I think there are attempts made to buy more airplanes, and I think there are defense on goods, which I think the government is looking at, and their energy, right, natural gas, liquid natural gas, and which could all be put and brought into the system. If you then think about what are you exporting, again, I think that probably depends a little bit on much more what kind of supply chain elements would you actually be taken back from Vietnam into the US. But to be fair, if you ask some of the experts, they would probably say even refactoring 10% of your supply chain will probably take 3 to 4 years. And then the question is, what will you take back to the US? Will you take back wood furnitures? Are you taking back some agro products? Are you taking back garments and shoes? And a lot of these products are actually something you don't want to produce in the US. And then where else will you actually produce it? So I think it's a rather complicated discussion, and therefore, as Alex said, you can only think in scenarios, right? And if it really comes down to we stay at 46% and surrounding countries like Indonesia, Malaysia, Thailand, which are also able to produce some of these goods, are staying at a much lower range, then again, probably you could see that exports might be dropping between 5 to 15%. You could probably assume that FDIs are slowing down, and because you might not get so much registrations and disbursement, let's say maybe up to -5%. The GDP growth would go to the 4%, and as we said, which is the pessimistic scenario. But you just would need to think about that because of the 9 days, and we have 7% in the first quarter, and then we basically have another probably strong quarter still. And so we'll probably still get somewhere like 6.5 in order to get to 4, right? You would actually need to see that the second half of the year would be at 2% GDP growth, which is lower than what we had during COVID. And so it would be a massive slowdown of the economy. And that would be despite the counteracting of the government, which actually still has a lot of disbursement powers and fiscal power. So we're really having in the 4% scenario, it's a massive, massive break in the entire economic model of Vietnam, which at this point in time, again, would be a little bit hard to see that this was actually happening. But again, you could say maybe it's 4%. Inflation, I think, will be remaining relatively stable in that environment. The dollar or the US, probably the dong would depreciate because usually there is a movement to more stable currencies. However, we should also basically take a look at it is that usually in a time of crisis, everyone goes to the US dollar. At this point in time, you see actually that the euro has gained against the US dollar by roughly 10%. So something is really off. So it's not like that currently the US dollar will really appreciate massively. It might also be that people are taking dollars off the table, which depends a little bit on how the ultimate war between China and US is actually developing. So again, you have different scenarios, but let's say maybe a little bit depreciation, maybe around 3 to 5%. And then probably interest rates will go up a little bit, maybe 20 basis points, 30 basis points. And the reason here would be that you're assuming that in such a scenario, if tariffs are very high, you would actually have inflation in the US, which means that the Fed would probably still be very tight. And as long as they are tight, they will actually keep the interest rates up, which means there is not so much of a decoupling happening to the Vietnamese dong. And if you don't want your currency completely slide. So again, you probably would still see a little bit of an upward pressure, but again, we don't think too much, 20 basis points, 30 basis points. In that scenario, of course, credit growth would also be getting down. So we would probably not expect a 16% credit growth. You would actually see it going down. At the same point in time, probably also deposit growth would be going down. I think that's the underlying 4% scenario. But as Alex said, there is a lot of room for everything in between. And at this point in time, we are still leaning more towards an optimistic scenario.
Thanks, Jens. Next question is also for Jens. Could you share your view on the recovery momentum in the real estate market? Specifically, the recovery momentum in 2024, will it continue to be maintained or accelerate in 2025?
So I think what we've seen is clearly a recovery, as people said, in 2024, but a lot of this recovery was actually in the north, and a lot of this was also surrounding probably mostly high rises. And I think landed properties were also doing quite okay in both areas, in Ho Chi Minh in the south as well in the north, but landed properties, especially in the south, were actually complicated. So what are we seeing? And I still believe there are a lot of new products coming up and people are excited about it. There is still a question, where do you invest in uncertain times? And what you've seen is the gold price is going up tremendously. But again, I think people, especially Vietnamese, are still thinking that investments in real estate is actually a good option. That's why you see also the prices going up, right? And so there's still a lot of demand. So I think the demand is still there. In the north, clearly, especially when it comes to high end, it might be actually getting a little bit more constrained in the south. And the reason is that a lot of the value creation and a lot of the wealth creation in the south is actually from entrepreneurial talent, from people who are basically trading and who are in that supply chain. And if that's not helping, and if that's not coming up, and then I think people will just be careful. And that's already when we talk to our customers, and having the experience of kind of 20 and of COVID, but also after the SCB crisis, people are just a little bit careful. So therefore, again, investments are or investors are a bit reluctant. So therefore, again, and also coupled with not a lot of supply, I think we're still probably looking a little bit of an extended kind of run in the south. However, what's also very clear, the moment good products are entering the market, and especially on high rises and all of that, you see that actually demand is very high, and these absorption rates are very, very quick and very high. So from that perspective, I think the market is there. There's demand, and it will be slowing down a little bit at the top end, and I think that's probably pretty much predictable. The moment and you have good supply in the south, I think it will be absorbed. But again, I think something at the higher end of the segment, that will probably take a little bit of time given that uncertainty and volatility we're currently seeing.
Thanks. The next question is for Alex. Could you provide an update on the bond market on the first quarter, including the share for Techcombank and TCBS in 2025?
Yeah, with pleasure. So clearly, bond market in the first quarter of 25 was quite strong. The overall volume of issuances was 30 trillion, which is broadly in line with the same quarter of 2024. There were 19 actually issuers issuing bonds. If we look at the breakdown by sector, then banks continue to dominate bond issuance around 60% of the market. We also saw some increased interest for listed bonds. There was around 6 trillion of newly issued listed bonds, which is positive. It increases actually the stock of listed bonds to a little bit less than 100 trillion, which is up 57% year on year. And this is an encouraging trend because we will need more and more of this class of assets in order to extend the access to these fixed income instruments to a wider range of customers in Vietnam. If we look now at non-banking bonds, then TCBS achieved a 57% market share on bond issuance, which is, I think, quite impressive. If you asked about our forecast for the full year, so we are quite bullish for the corporate bond market. We believe that there are a number of supporting factors like the improving real estate market, as Jens explained, the investment also of the government into a wide range of projects, including on the infrastructure side, and also the relatively robust growth of the economy, particularly on the business side. So all these factors mean that the volume of bonds originated in 2025 should stay at an elevated level, and we believe that TCBS will be able to continue to capture a significant proportion of this market.
Thanks. The next question is for Jens. Techcombank has been successful over the last 10 years in terms of transformation, and now you're embarking on the next 5 years. What will be the bank's strategy?
And thank you for the question. So we will continue to do what we've done over the last 10 years, right? So we will actually focus very much on the customer and being relevant to the customer in whatever kind of needs they have. And so some of the key changes we might probably see, or some of the themes we actually need to work on, is I think we can expand into kind of other parts of our ecosystem. What I mean with that is, usually in the morning you don't wake up and you're thinking about a banking product, but you think about real needs, and you need to educate your children, you need to get from point A to point B, and you're having a cough, so you need to make sure that you're actually healthy. And these are the real needs. And I think what we are trying to do is we're trying to basically be relevant and in order to serve these needs. And so therefore we were working very much with the key players in this market who are fulfilling these needs in order to provide the best solutions for fulfilling the needs, but also the financial means which are underlying that, which could be insurance, which could be mortgages, which could be credit and pure payment transactions, etc. So again, from our perspective, one thing is really we want to be more and directly relevant to more customers, and that is why you're seeing us expanding our overall kind of market share in terms of pure number of customers, but also because we're going into additional products like insurance and non-life insurance and wealth management and in new sectors like health. So that's one area. The other one is it's very clear what we did over the last 10 years, but especially over the last 5 years, we put digital into everything what we did. And I think the next 5 years we will put AI into everything what we are doing. And we really believe that AI is a fundamental game changer. And the good thing is that by luck or by strategy, we build up all the data capabilities over the last couple of years. And you recall that we always talk about digital talent and data. And so our data sets and what we have developed on the data side now allows us to actually really be on the forefront on taking AI applications and put them into everything what we're doing, and which allows efficiency, but also create completely new experiences and better experiences as we make more and more information available directly to our customers, but also to our front-end staff. So again, still being customer centric, but being more relevant in more areas, and then at the same point in time, just being better in understanding our customers and delivering something which is really hyper personalized by using all the technology we have put in place. And we're working on refining our next 5-year strategy. And so probably Q3, and we will come back with probably more detailed description of what we have in mind and what we will actually do.
Thanks. The next question is for Alex. What are the key contributors to credit growth for the first quarter? And then could you update on the diversification strategy for the full year?
Yeah, thank you for the question. So credit books, as I mentioned, grew 4% this quarter, and this was relatively balanced between retail books and corporate books. So within retail books, we had some strong demand, as I mentioned, for primary mortgages, and this represented around half of the growth of the book this quarter. The other half came from margin lending, which was up 18% quarter on quarter, and also from financing to household and SME customers. The two products, specific products we put out in the market last year, so Shop Credit and Shop Cash, achieved a very impressive growth of 55% quarter on quarter. So that's for the growth of our retail books. On the corporate books, the fastest expansion came from FMCG, which grew 15% quarter on quarter, as well as utilities up 8% quarter on quarter. As I mentioned, we saw also some healthy expansion in the real estate books in line with the recovery of the real estate market, and also the commercialization of a few mega projects in the metropolitan areas of Hanoi, Hung Yen, Haiphong, and HCMC. Regarding your question around the diversification strategy, so as I mentioned during my presentation, we are not walking away of our objective in this respect. It remains to continue to diversify away from real estate and into other sectors. Our exposure to real estate sector went up a bit this quarter. However, we believe that it will go down again in the coming quarters, and that it will go down further at the end of 2025. In other terms, we should see more or less the same dynamics as in 2024, when we managed to reduce our exposure to real estate sector by a few percentage points.
Thanks, Alex. Next question is also for Alex on asset quality. Why did the debt group 5 increase rapidly in the first quarter? And do you expect any macro headwinds that might impact customers and in terms of NPL for the mortgage book for this year?
Yeah, no, thanks. Thanks for this question, and obviously, like the other ones, very topical. So first, starting with the bucket 5, I would not read too much in the fact that our bucket 5 exposure went up a bit this quarter. As you know, the structure by bucket of our loan books follows two main drivers. The first one is the normal maturation of the books. As time passes by, if nothing happens, then you would have credit exposures moving from bucket 2 to bucket 3 to bucket 4 to bucket 5. The only reason it would not go down the buckets is if the bank manages to recover the debt by selling it or by repossessing the assets or through any other way. So that's what we call the workout, and the percentage of workout by bucket will differ, and it will also differ from quarter to quarter. Therefore, what you should rather focus on is the overall NPL balances, and as I mentioned, they stayed broadly flat this quarter at a percentage of our total loan exposures, as well as our credit risk. And as I mentioned, our total credit risk on a last 12 months basis actually went down this quarter. Now to your second question about the impact of tariffs, and then maybe you mentioned retail books, but I will broaden it to the entire bank books. So the first comment I would make is that as Jens mentioned, and as I said during my presentation, there is clearly a pessimistic scenario and an optimistic scenario, and both are likely, right? If the pessimistic scenario is the one which unfolds, then obviously there will be a higher organic level of delinquency in the economy, as is observed always when there is an economic slowdown, but this will probably impact all components of our books, and hopefully should also stay relatively limited in terms of magnitude, particularly given that we have around 90% of our credit exposures which are secured with collateral. The question you may have is there a risk in this pessimistic scenario that we have big chunks of our corporate books suddenly going straight into delinquency and NPL? So in order to answer this question, we looked at the books and also the proportion of assets which are with customers who either export directly in large quantity to the US or export to China for then further export from China to the US. When you combine these exposures, then these represent only around 3% of our total asset books, which is not large. And that's essentially the reason why we maintained our full year guidance of NPL ratio below 1.5% and credit cost below 1%, despite the fact that there is, as we mentioned, significant economic uncertainty at this level.
Thanks. Next question is also for Alex. You may have covered this in the main presentation, but could you expand a little bit on the movement in operating expenses in the first quarter and the guidance for the rest of the year?
Yeah, sure. So as you said, I covered it largely during my presentation. The two main drivers which explain why our costs this quarter stayed broadly flat compared to the same period last year are first the adjustments of our bonus accruals. This is something which we do at the beginning of each year based on the performance of the bank. And then the second factor was an adjustment made to the cost provisions for staff benefits. It's not actually impacting the economic overall economic benefits provided to our staff. It's more a change, I would say, movement in the accounting linked to the characteristics of the staff benefits. Now, if you look forward to the full year, then actually I would say that our cost increase will probably be around the 10% mark. It could be lower or it could be higher than that, let's say 5 to 15%, depending of the TOI and the momentum in the profits of the bank. If there is more TOI, then actually probably the bonus accruals will be higher, and we will also be able to afford a higher amount of marketing and vice versa. Which means that in all scenarios, our cost-income ratio will probably be in the lower end of the 30 to 35% target range.
Thanks. Next question is also for Alex on NIM. Previously, you said that auto earnings helps to lower the cost of fund. Do you still believe this is true? Because we did see NIM drop below 4% this quarter.
Yeah, it's absolutely true. At the same time, I completely understand why you would want to ask this question. If you look at the blended cost of CASA plus auto earning account, then it's around 1.5, 1.8%. And if you compare that to the cost of average term deposit, then it's 3.9%. So then the conclusion is clear, right? If you are able to move more of your deposits from term deposits to auto earning, or let's put it differently, if you are able to grow your CASA and auto earnings faster than you grow your term deposit, then absolutely your cost of funds will go down. And that's what we were able to achieve in the first quarter of this year. Despite the pressure on term deposits, we were able to maintain our cost of funding and actually reduce it slightly. You do not see it too much because of the rounding, but it did go down a few basis points between the first quarter and the last quarter of 2024.
Thanks. The next question is for Jens. Techcombank's auto earnings was very successful in 2024. But what we've seen is it's been copied by your peers. What strategy do you have to stay ahead of the competition, given that and have they caught up to you?
Thank you very much for the question. So I think, and I need to be careful what I'm saying, but I think so far the copying has happened in name only. So I think it's called auto earning or whatever it's called, but I think it's a little bit saying a feature phone and an iPhone is exactly the same thing, and ultimately it's a phone. And while that is true, I'm not saying that. I think if we really go through the details, and I made this comment beforehand, if we really go and try to decompose the product, it requires a lot of capabilities on the technology side, and on wealth management, on a lot of different areas, right? And so if you look through the key components, right, which is actually, so it needs to be profitable, it needs to be flexible, it needs to be secure. So profitable, if you look at it, we're basically saying whatever your balance, we will actually pay the interest on the entire balance. And the more and the higher your balance is, the more we actually pay you. So a lot of the products which you're seeing right now are more like the first version where where people were basically saying, oh, I take a certain amount and that I put away and I put it into a certificate of deposit or something like that, and which is very different to what we are doing right now, right? We're basically saying the entire balance will actually be optimized. I think much more important is actually the flexible, right? You can use your account, the auto earning account of Techcombank, completely as a payment account. You pay immediately, the money goes out. There's no restriction, right? This is really like a normal payment account and a normal current account. You don't need to activate anything. You don't need to get money back. You don't need to wait. Nothing needs to happen. And again, if you look in detail through the other products, I think none of that is actually on providing that. And so if you really then want to go and saying, I want to replicate exactly that experience, and you also want to basically show how much money you've made on a daily basis. So all the features which we actually have in our product. Again, you need to be able to do a lot of things in the back end when it comes to technology, digital, automated wealth management, and AI, etc., etc. So yes, I think people are saying it's auto earning, but so far every single day 11,000 customers are activating it with us. We have more than 3 million customers who are basically using that feature. Again, I don't know, I have the numbers from the other banks, but I'm pretty sure it looks a little bit different, right? And I think over the last year, if I'm not wrong, I think we somewhere have about 38 trillion or something like that, which is in these AE balances. So let's see where others are coming out. But I think once you start realizing what the difference is, you will probably realize that auto earning and saying it's auto earning is a little bit different. So from that perspective, we feel actually quite comfortable. Usually, and copying is a sign of flattery. So and we take that, but it will take really quite some time until you get anywhere close to what we currently have. And you should also assume we're not standing still, right? So we are doing the same thing. And so I'm actually quite okay.
Thanks. Next question is for Alex. Alex, you mentioned that post the Manulife separation, there was a temporary partnerships with other insurance companies for distribution. What is the plan going forward? Will there be a partner? Will you have upfront fees?
Yeah, thanks for asking about our insurance strategy. It's clearly an area where we have big ambitions and a number of strategic changes are happening. If I start with general insurance, if you remember, we started our general insurance business in December last year. This quarter, we are already seeing some encouraging trend, particularly for home products, home protection. And in the coming quarters, we will look to also launch new products on credit life, on healthcare, right? So overall, we hope to have at the end of the year a general insurance business which will be operated out of a subsidiary of the bank with a 68% participation of the bank in the capital, and a business which will represent maybe 15% of the fee income, overall banker fee income, and will be therefore making significant contribution to our banker strategy. So that's for the general insurance business. Turning now on to life insurance. So as you said, at the end of 2024, we terminated on amicable terms our exclusive distribution agreement with Manulife, and we put in place new temporary distribution agreements. These temporary distribution agreements are showing some encouraging results. The banker fees in the first quarter of 25 were up 44% compared to the same period of last year. However, as you know, this is not the end game. The objective remains to set up our own insurance subsidiary. In February, we sought the approval of our shareholders to do that, and we are currently taking steps in order to obtain the license to operate our insurance subsidiary, and we hope to receive it during the summer. So far, things are going well, and we will be therefore looking to launch our business toward the end of the year. So this is quite an ambitious plan. So what about partner? Our objective is indeed to bring a global insurer as a partner in the setup of this new insurance company. This partner will be given access to our customer base, to our branch network, to our digital distribution capabilities. Those are all valuable assets which require a lot of time and a lot of investment to build. And from that point of view, it makes sense, in our opinion, for the shareholders of the bank to receive some form of compensation if the partner is given access to these assets. And this compensation could absolutely take the form, at least for part of it, of an upfront payment. However, as I said, on the financial terms haven't been decided yet. The selection of the partner hasn't been completed yet, even though we are seeing a lot of interest and having a lot of very positive discussions with potential partners. Overall, therefore, the direction of travel for our insurance business is clear. Hopefully, by the end of the year, we will have two subsidiaries, two consolidated subsidiaries, one for general insurance, one for life insurance. And in both cases, it will allow us to have full control, full end-to-end control over the customer experience, from product design to underwriting to claim management, right? And the objective for us will be to offer the best possible experience, leveraging our ecosystems, but also leveraging our customer centricity, ability to provide highly relevant advice, to provide the best possible digital experience, and to provide world-class services. So I would say it's a very exciting project, and one which entails a lot of potential opportunities for the bank. I think in a few years' time, this is a business which has the potential to make a very significant contribution to the profits of Techcombank to the same level, if not higher, than TCBS.
Thanks, Alex. Next question is for Jens. Could you update us on the plans for TCBS IPO?
Sure, it seems to be like an evergreen question. So, and thank you for that. So we still maintain the same perspective as what we had in the past. I think if TCBS finds a good partner, and we believe that by basically IPOing pieces of or parts of TCBS to discover the value of TCBS, which would also lead to a re-rating of TCB, then we would actually be doing it. And I think what we can probably say that we don't necessarily need the capital. And I think, as we said, our capital base is actually very, very high. If we now start issuing TCBS and we get some money for that, because it's still actually at a relatively low level from a book value in our books, then again, while we would realize a lot of profit, it would basically increase the capital base of the bank, which we could dividend out, but we would not necessarily need it for expanding our business. So again, I think these are the considerations on which we have. So is there a partner, and do we think it helps kind of the value discovery, and then what exactly are we doing with the proceeds? I think it's fair to say that in the context also of building up the insurance companies and all of that, we're looking more holistically how we're setting up our businesses, and especially our subsidiaries. And in that context, as we said, there's Q3, Q4, and in that context, something might materialize, but we would inform once we have really made our mind up, and we would actually inform and according to the regulatory requirements, exactly at this point in time what we intend to do and how we would actually be doing it.
Thanks. Next question is for Alex. Given TCBS's strong quarter, what are going to be the key drivers for the rest of the year, and what are the key targets?
Yeah, thank you. I agree with you. TCBS had a very strong quarter. So they generated 1.3 trillion of PBT. This was 13% up year on year and around 40% quarter on quarter. The return on asset was 8%, and the market share on the HOSI was 7.5%. So for 2025, the objective of the company will be to continue to manage the significant volatility that we can expect in financial markets. We will stick to our strategy of sustainable development, superior profitability, superior cost-income ratio. In terms of the strategic pillars that will remain unchanged, the first one is human capital, so TCBS as one of the I think most interesting mix of skills and expertise in this workforce, with a very high components of highly skilled financial experts and technology experts. The second one is technology, which will entail also a greater focus on blockchain and AI this year. And then the third one is data, in-depth analysis and insights, allowing our customers to take timely and effective investment decisions. So how does this translate into concretely in terms of products and propositions? So first, we will look to expand our one-stop shop investment platform on mobile and digital. So this will entail new products like trackers, warrants, ETFs, and other digital products, which will allow our customers to have a very comprehensive management of their wealth. The second component will be to expand our digital, our distribution channels. We will look to enter into new distribution partnerships, which will give us access to a wider range of customers. And the third aspect is blockchain. We plan to double down on blockchain technologies to offer new and differentiating propositions, which will be more both more convenient and also more efficient in terms of cost per transaction, as well as more transparent. So I think it's going to be again a very interesting and fruitful year for TCBS, during which we will look to continue to expand our market share and differentiate ourselves for the traditional players in the securities industry.
Thanks. The next question is for Jens. Many industries, including banking, have cut a lot of employees due to market conditions and automation. What is Techcombank's perspective? Do you see any cuts to staff going forward?
Yeah, thank you for the question. So the simple answer is no. And what we've done already over the last couple of years, actually since we started on that transformation journey, we were always very observant in terms of how we actually kind of hire, in which areas we bring people in, and etc. So over the last, I don't know, 2 or 3 years, we probably kept our overall headcount relatively stable, while at the same point in time we expanded our business continuously. So if you think about the pure expansion in terms of customers, we're probably double or more than what we had in 2020 or 2021, while the overall headcount is actually relatively stable. So we always had productivity improvements in our agenda, but we never overstaffed and therefore needed to bring it down, but we just controlled the growth of our staff. So it's a little bit like if you see also a lot of the debates and discussions which are happening in other parts of the world, or if you're already a bank which might not have done some of these adjustments already over the last couple of years, then I think you're forced with that decision making. And from our perspective, we're actually on the lookout for talent. I think that staff will go up. Because we are expanding in areas, as we said, right, we're thinking about, should we do more on the non-life side? Are we doing more on the life side? We have expansion plans for TCBS. As we have more and more customers, and what Alex just thought on the wealth management side, I think for a long time, and that will not be replaced by artificial intelligence. I think this will, RM will get enhancements, but they're still very important to have people. And we're still looking for and building more and more digital capabilities. So what we will see is we will shift again more of our talent into digital technology data, when we started in 2021, 4% of our staff were in these technology areas. Now we're at around 15%. I think we will drive it to 25 or 30%. In companies like TCBS, this number already is at 50 or 60%. So we will push that. But again, we will also continue to hire more people in front and office related roles like relationship managers, product specialists, etc. So we are actually using all these automation and advantages which we have. But again, I think given our growth, we are not looking for retrenching people. We are actually really looking for finding more staff in the key areas. And so we'll probably go a little bit against the trend, but I expect that would be true for a lot of banks who have winning propositions and who will right now use the current changes in the industry to actually expand their business.
Thanks. The next question is for Alex. Given the fluctuations in the macro environment due to tariffs, will there be any increased demand for hedging in your LC and the FX trade business going forward?
Yeah, thanks for the question, and I think it's a reasonable assumption, right? And I would be tempted to make the same comment or the same prediction. Even though the tariffs could have overall a negative impact on the exports and the economy, and therefore negative impact you would expect on FX and trade businesses, in reality you need to look at this a bit more closely. If you look at FX, as you said, there will be a need for more close management of the FX exposure, FX risks, and the bank is well equipped to deal with the needs of its customers with a wide range of products going from cash FX to swaps to forwards to structured derivatives. So therefore we expect that there could be a higher demand from these FX risk management tools. And then beyond that, as Jens alluded to, we can already see some interest for some customers to explore payments in other currencies than US dollars, which means that there could be also opportunities to sell FX products on other currency pairs than just dong versus US dollars. And then looking at LC business, which was the second part of your question, I would be tempted to make again the same assumption as you. Even though the overall volume of trade globally could decrease, in reality there could be also a higher interest for some customers to resort to tried and tested payment methods like letters of credit, particularly when it comes to setting up new trading relationships, and particularly there would be potentially moving some of their exports out of the US and toward other destinations in the region.
Thanks. And last question is for Jens. Given that Alex just gave fiscal 25 guidance and the tariff situation is still in flux, what assumptions is in that guidance, and how should we think about it when and if you have to adjust that guidance?
So I think that's and I think that's a good question. I think probably we'll know a little bit more in the end of the second quarter once we are clear in where is this tariff world and ultimately ending, right? And I think there are probably certain things which are pretty clear that, and I think there will still be very high tariffs on US and China amongst their own trade flows, but where the rest of the world will be standing is a little bit unclear. And however, I think we also showed you a slide in the beginning where we said what was the PBT through the cycle. So and I think you had COVID in 2021 or 2020 to 21, and then still 22. Then you had actually Saigon Commercial Bank, and then you had the real estate market collapsing, and then you had the bank insurance market basically coming down, and then you had the crisis with the Ukraine, and now we have the tariffs. So I think we're living in interesting times, right? And management is usually getting paid to manage right? Because otherwise you just live with the implications of what's coming to you, and then you're not doing anything. So I think we have a pretty good track record of mitigating a crisis and still somewhat getting the trajectory towards kind of on an upward slope. And so therefore, yes, we might actually be seeing volatility, so we're not taking that away. But we believe, and as also Alex said, in every situation there will be also opportunities, and suddenly people will go and discover new markets, right? Or that maybe some other markets where have even higher tariffs might actually shift over here. So we don't know exactly, and we also still believe that there's a lot of fundamental reshaping happening, which the government is doing. So, and there's a lot of room for fiscal and expansion, and we still have a very low and government debt, and there's a lot of ambition in terms of getting us to a growth trajectory which is closer to what South Korea has seen or Taiwan has seen. So infrastructure there and investments are roughly 5,500 trillion over the next 5 years. So there's a lot of other things which are actually happening. And so from that perspective, good, or if there's a crisis, there will always be also certain opportunities. So we will give guidance, and we will also not be just saying, okay, nothing is wrong and everything is fine, if we really see that certain things are not being able to be managed. But as we said, right now, in our scenario, which is rather probably more at the upper end, and not the 4% scenario, right? And then I think we should still be able and to somewhere get to the 31.5. But as we said, if there's a complete rethink and required because we're ending up in the pessimistic scenario, then we definitely will come back and basically will explain how we're seeing the development for this year and potentially even for some of the years going forward. But again, I think we're still very far away from that.
Thank you, Jens. This concludes the first quarter 2025 financial results presentation. The presentation and replay link will be posted on the IR section of the website soon. Please contact the IR team for any additional questions. We look forward to speaking to you again in 3 months.